You walk into a casino, you sit at a poker table. You think you're playing a fair game until you realize the dealer, the other players, even the audience, all know each other. You're the only one who doesn't. That's not just a casino, that's the stock market. Remember, rounders? If you can't spot the sucker in your first half hour at the table, then you are the sucker. The market works the same way. You can win, but only if you understand the real game. Because here's the truth. The system is rigged. This is how the stock market really works, where the people who make the rules don't follow them. What the market pretends to be, and why that belief is costing you money. You've probably heard the story. The stock market is where companies raise money and smart investors build wealth. Buy low, sell high, retire early. That's the version they want you to believe. But the real game? It's messier, more complex, and far more rigged than it looks. And to even start spotting the tricks, you need to understand two terms you think you already know: stock and IPO. A stock, it's simply a small piece of a company. If you buy Apple stock, you technically own a tiny slice of Apple. The company uses your money to grow, and if they do well, you share in the profits. An IPO, initial public offering, is when a private company sells shares to the public for the first time. The company raises capital. Early insiders cash out. And you, the public, finally get your shot at full price. On paper, it looks like a win-win. Companies get the cash they need. You invest. Everyone wins. Right? Not exactly. Let's take a detour to The Big Short, the 2015 film about the housing crash. A few outsiders dig into what Wall Street calls safe investments, only to find the entire system is stacked on garbage loans. It looked solid on the surface, but it was already crumbling underneath. That's the stock market too. A company can report record profits and still see its stock plunge. Why? Because Wall Street expected more. And when those expectations aren't met, even slightly, boom, the stock tanks. Here's the twist. Price isn't truth. Price is belief. It doesn't matter how good the business is. It matters how people feel about it. The market doesn't reward logic. It runs on emotion, momentum, and media buzz. So who's really controlling the game? You're not playing the same game as the big players. In fact, you're not even on the same field. Because behind every market move, there's a second game happening. And in this hidden game, three things matter: speed, access, and information. While you're placing a trade on your phone, hedge funds are running algorithms that execute thousands of trades in microseconds. They can see your order before it's even filled and jump ahead of you to profit. It's called high-frequency trading, and it's like racing a go-kart while they're flying past you in a Formula One car. Think that sounds like an exaggeration? It's not. Margin Call nailed it. A big firm sees the crash coming and quietly dumps toxic assets before the world catches on. The public loses billions. The insiders, they move first and walk away clean. And that's just one layer. Apps like Robinhood say they offer free trading, but they're not running a charity. They make money by selling your trade data to hedge funds through something called payment for order flow. That means your order becomes their signal. While you think you're buying at market price, they've already bought it and are selling it to you for a markup. But here's the real issue. Retail investors like us are always playing blind. When a stock suddenly spikes or crashes, you see the result, not the cause. Was it a pension fund making $1 billion move, or bots faking volume to trap you into buying? You're playing poker, but everyone else sees your cards, and theirs are face down. By the time you hear Tesla's earnings, someone else has already traded it, analyzed it, and moved on. High-frequency firms put their servers physically next to the exchange so they receive info milliseconds faster. Institutional investors get private briefings and early analyst reports. You get whatever's left after they've made their moves. Even the media is part of the system. Financial influencers hype coins they were paid to promote. YouTubers pump stocks from sponsors. Even TV experts push shares they already own. You think you're getting analysis. You're actually watching an exit plan. If they bought early and you bought after watching them, they profited. You paid. You're not making choices. You're being steered by hype, media, and emotion. And if your best trade still lost money, maybe someone else saw your move before you even made it. Here's the part nobody wants to hear. This isn't a bug. It's a feature of the system. Every trade you place goes through multiple middlemen. Each one takes a cut. Each one sees the data you never do. They operate on a level you'll never access. And the wildest part? It's not illegal, it's not hidden. It's documented. Public, normalized. Payment for order flow is disclosed. High-frequency traders publish white papers on their speed hacks. Hedge funds share strategies on stage at financial conferences. So if you've ever felt like the game was rigged, it's because it is. Not against your intelligence, but against your access. You're not losing because you're dumb. You're losing because the rules were never written for you. Want to see how hidden access and information sharing can bankroll insiders while ruining regular investors? Let's talk about Enron. At its peak, Enron was one of America's top companies, praised by analysts, adored by investors. But behind the scenes, it was a house of cards. They used a trick called mark-to-market accounting, which meant they could sign a 10-year deal and instantly book all the future profits, even if those profits never came. They also set up special purpose entities to bury billions in debt off their balance sheet. From the outside, Enron looked like it was booming. On the inside, executives knew it was rotting, and while they were quietly dumping their shares, regular investors, trusting the headlines, kept buying. When the truth came out, Enron's stock plummeted from $90 to under $1. Employees lost their savings, investors were wiped out. But the insiders? They walked away with millions. Because they had the one thing that mattered most: speed, access, and information. So you might be thinking, what can I actually do? By now, you've seen it. The stock market isn't a level playing field. It's a maze, built to reward insiders and confuse the rest. But here's the twist. You don't have to beat Wall Street. You just have to stop playing their game and start mastering yours. Think of Limitless. Eddie doesn't outpunch the world. He outthinks it. He stops reacting to noise and starts making intentional moves. That's your advantage too. Clarity. You can't outtrade a bot, but you can do something way more powerful. You can beat fear. When everyone else panics, you stay patient. When hype takes over, you step back. When influencers scream, "buy now," you already bought weeks ago. Real investors don't chase headlines, they build conviction. They track patterns, not promos. They ask, why is this cheap? Not, why is this trending? Because the truth is, the biggest wins, they don't come from chasing noise, they come from silent conviction, held when no one else is looking. If you're wondering how anyone can compete with billion-dollar hedge funds, then you need to hear this story. Meet Navinder Sarao, a solo trader operating from a small bedroom in his parents' home in London. No Wall Street connections, no fancy degrees, just a laptop, some custom software, and a deep understanding of how the market really works. Sarao hated high-frequency traders, the hedge funds using lightning-fast algorithms to front-run the market. So he did what few dared to try. He beat them at their own game. Using a tactic called spoofing, he placed fake orders on S&P 500 futures, creating the illusion of demand, then canceling those orders milliseconds before execution. That illusion fooled high-frequency trading algorithms into thinking a big buy was coming. So they rushed in first, driving the price up. Then, Sarao canceled his orders and sold into the inflated market for a profit. It wasn't illegal at first, but it was pure manipulation. And it worked. On May 6, 2010, his spoofing helped trigger the flash crash, a 36-minute collapse that wiped $1 trillion off the US stock market. The Dow plunged 1,000 points before bouncing back. Traders panicked, algos melted down, screens froze, and Sarao, he walked away with $880,000 in under an hour. Because when you understand the game, you don't need billions. You just need speed, strategy, and access. If one man with a keyboard can bring Wall Street to its knees, you better believe you can make a fortune from the stock market. So what does this mean for you? Let's be clear, this isn't about avoiding the market. It's about understanding the real game you're stepping into. When you buy a stock, you're not just betting on a company. You're betting that you won't get front-run by an algorithm. You won't get dumped on by insiders. You won't get trapped in someone else's hype cycle. Sometimes that bet pays off, but only if you know what you're really betting on. Because this market, it's not just about profits, it's about power. The power to see the data first, the power to change the rules mid-game, the power to win while you're still trying to figure out what just happened, and it never ends. New tokens, new influencers, new once-in-a-lifetime opportunities. But the rules, they never change. Whoever controls the information controls the outcome. Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and explore intriguing money movies, all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.